Navigating the investment landscape. The impact of sector-specific risks on diversified portfolios. Introduction. In the realm of investment strategy, the concept of diversification is often heralded as a risk mitigation tool. However, beneath the surface of a diversified portfolio lies a nuanced landscape influenced by sector-specific risks. Understanding how these risks permeate investment choices is essential for investors seeking to construct resilient portfolios capable of weathering the uncertainties inherent in various sectors. The diversified portfolio canvas. A diversified portfolio is akin to a well-curated art collection, each asset representing a unique brushstroke contributing to the overall composition. The aim is to blend assets with varying risk profiles, returns, and market correlations, thereby reducing the impact of adverse events in any single sector. However, the efficacy of diversification hinges on a nuanced understanding of the risks embedded within each sector, as sector-specific dynamics can amplify or mitigate overall portfolio risk. Sector-specific risks unveiled. Every sector within the market ecosystem carries its own set of risks, influenced by factors such as economic cycles, regulatory changes, technological disruptions, and global geopolitical events. For instance, technology companies may grapple with rapid innovation cycles and the threat of obsolescence, while energy companies face the volatility of commodity prices and geopolitical tensions impacting the supply chain. Understanding how these sector-specific risks manifest is crucial for investors aiming to navigate the complex interplay between diversification and risk mitigation. The financial sector, for example, is sensitive to interest rate fluctuations, while the healthcare sector may face regulatory uncertainties. The cyclical nature of sectors like consumer discretionary and industrials makes them vulnerable to economic downturns. Emphasizing the need for a nuanced approach to risk management in a diversified portfolio. Risk-return trade-off across sectors. The risk-return trade-off is a fundamental principle in investment, and it manifests vividly when examining sector-specific risks. Some sectors, characterized by higher inherent risks, may offer the potential for substantial returns. Conversely, defensive sectors with lower risk profiles may provide more stable but modest returns. Consider the technology sector, renowned for its innovation and growth potential. While investing in tech stocks may yield impressive returns during periods of industry expansion, these companies are also susceptible to rapid market shifts and regulatory scrutiny. In contrast, defensive sectors like utilities or consumer staples, though less prone to volatility, may offer more conservative returns. Striking the right balance within a diversified portfolio entails weighing the risk-return profiles of different sectors to align with an investor's objectives and risk tolerance. Cyclical versus non-cyclical sectors. Categorizing sectors as cyclical or non-cyclical adds another layer of complexity to sector-specific risk analysis. Cyclical sectors, such as consumer discretionary and industrials, tend to ebb and flow with economic cycles. Non-cyclical sectors, including healthcare and utilities, exhibit more stable performance regardless of economic conditions. During economic expansions, investors may favor cyclical sectors for their growth potential, while turning to non-cyclical sectors as defensive havens during downturns. Recognizing the cyclical nature of sectors helps investors tailor their portfolios to navigate the broader economic climate. Strategically adjusting allocations to manage sector-specific risks within the context of market cycles. Global dynamics and sector-specific risks. The interconnectedness of global markets introduces an additional layer of complexity to sector-specific risks. Multinational corporations may face challenges arising from geopolitical events, currency fluctuations, and varying regulatory environments across different countries. For instance, a pharmaceutical company operating globally may encounter regulatory hurdles in one jurisdiction while benefiting from favorable conditions in another. Investors must factor in these global dynamics when assessing sector-specific risks. Considering the potential impact of geopolitical tensions, trade policies, and currency movements on their diversified portfolios. A meticulous understanding of the international landscape enhances risk management strategies, ensuring that sector-specific risks are comprehensively evaluated within a global context. Dynamic nature of sector-specific risks. Sector-specific risks are not static. They evolve with changing market conditions, technological advancements, and regulatory landscapes. A sector that thrives in one economic environment may face headwinds in another. Investors must adopt a dynamic approach to risk management within their diversified portfolios, regularly reassessing sector exposures and adjusting allocations to align with evolving market dynamics. For example, the rise of environmental, social, and governance (ESG) considerations has introduced a new layer of risk for investors. Companies in traditionally lucrative sectors may face challenges if they fail to adapt to evolving ESG standards, necessitating a recalibration of risk assessments within a diversified portfolio. Conclusion. In the intricate tapestry of diversified portfolios, sector-specific risks paint vibrant strokes that shape the overall risk profile and return potential. Acknowledging the nuanced dynamics within each sector, understanding the interplay of global influences, and recognizing the evolving nature of risks are paramount for investors aiming to construct portfolios that stand resilient in the face of uncertainties. While diversification remains a cornerstone of risk management, its effectiveness relies on a keen awareness of the unique challenges and opportunities embedded within different sectors. Armed with this knowledge, investors can navigate the multifaceted landscape of sector-specific risks, crafting portfolios that not only weather the storms of market volatility, but also capture the diverse hues of growth and opportunity across the ever-changing financial canvas.